One is saving aggressively for a house they might never afford. The other is investing in crypto with money earned from a side hustle. Two generations, one wallet, but a world of difference in how they see it. Why does one fear another market crash while the other embraces financial risk? Welcome to the Economy Unpacked Daily YouTube channel. From Wall Street to your street, we share the world of money in a clear way. Today, we're dissecting the psychology of money and exploring how Gen Z and Millennials think differently about wealth. It's a story of contrast, shaped by two vastly different economic landscapes. Imagine a millennial, laser-focused on their 401k, haunted by memories of their parents losing everything in 2008. Now, picture a Gen Z investor, swiping through TikTok for the next big meme stock, driven by an optimism that seems almost reckless to their older counterparts. This contrast creates a fascinating tension, one that prompts us to ask, why does Gen Z save and invest so differently? And why do millennials seem perpetually braced for another financial catastrophe? To understand their choices, we have to look beyond the numbers and dive into the emotional currents that define their financial DNA. The constant barrage of inflation headlines, the allure of cryptocurrency, the convenience of mobile banking, this is the sensory overload of modern finance, and it's rewiring how we think, feel, and act when it comes to our money. The financial psychology of any generation is not innate. It's a direct product of the economic world they grew up in. To understand the why behind their behaviors, we need to rewind the clock. Millennials came of age in the shadow of the 2008 financial crash. They watched as the foundations of the global economy crumbled, taking with it the promise of stable careers and predictable financial milestones. This event, coupled with skyrocketing student debt and years of wage stagnation, imprinted a deep sense of caution. For many, this period wasn't just an economic downturn, it was a form of economic trauma, a term that captures the lasting psychological scars left by financial instability. This early life exposure to recession fostered a deep-seated risk aversion and a profound distrust in traditional financial institutions. Their financial conservatism isn't a personality flaw, it's a learned survival mechanism. In stark contrast, Gen Z's formative years were defined by a different set of crises and opportunities. They navigated the global disruption of the COVID-19 pandemic, a period that accelerated the shift to a fully digital world. They are the first generation to be native to the gig economy, where work is flexible but often precarious. They also experienced soaring inflation rates that have eroded their purchasing power from the moment they started earning. This unique blend of digitalization and instability has shaped a mindset that is simultaneously more adaptive and more willing to embrace unconventional financial paths. Watching archival clips of the 2008 market collapse alongside footage of empty city streets during COVID lockdowns helps build a bridge of empathy. It shows that neither generation's approach is inherently right or wrong. They are simply rational responses to the very different worlds that shaped them. These different economic backdrops have cultivated fundamentally different value systems and financial priorities. For many millennials, the primary goal has been to reclaim the stability that was denied to them. Their financial journey is often a quest for security, symbolized by traditional milestones, a stable career with a clear ladder to climb, home ownership, and a robust retirement fund. They value safety and predictability, often choosing the slow and steady path to wealth accumulation because they've seen firsthand how quickly fortunes can be lost. Gen Z, on the other hand, prioritizes flexibility, purpose, and personal well-being over traditional notions of stability. Having grown up in a world of constant change, they are less attached to the idea of a lifelong career or a single path to success. They are more likely to value experiences over possessions and seek work that aligns with their personal values, even if it means sacrificing a higher salary. This can be understood through the classic behavioral economics concept of delayed versus instant gratification. The digital culture Gen Z was raised in, with its on-demand everything, has reshaped their expectations around time and reward. Why save for 30 years for a mortgage when you can work remotely as a digital nomad and travel the world now? Visually, this contrast is powerful. A millennial meticulously tracking their savings for a down payment, juxtaposed with a Gen Z freelancer managing their digital income from a cafe in another country. Underneath it all, both generations are seeking a sense of control over their lives, one through the security of ownership, the other through the freedom of experience. This relentless pressure to achieve financial goals, whether traditional or modern, has given rise to a shared struggle: financial anxiety and burnout. Money is no longer just a tool. For many, it has become an immense emotional burden. However, the sources of this stress differ between the two generations. Millennials often suffer from the anxiety of delayed milestones. They feel the weight of societal expectations to buy a home, start a family, and build wealth, yet face economic hurdles that make these goals feel perpetually out of reach. This creates a gnawing sense of falling behind, a feeling that they are constantly running a race they can't win. Gen Z's anxiety stems from a different, more modern source: the relentless pressure of social comparison and digital exhaustion. They are navigating what's been called the dopamine economy, an environment of constant stimuli from likes, notifications, and targeted ads that rewires attention and weakens impulse control. This creates a volatile emotional cycle. The endless doom scrolling through social media feeds, filled with curated perfection, leads to an impulse buy for a moment of relief, which is quickly followed by guilt and anxiety. This, in turn, can trigger a frantic burst of saving, leading to a state of mental and emotional burnout. Keywords like financial burnout and money anxiety are not just buzzwords. They represent a real and growing mental health challenge, reflecting the profound emotional toll of managing money in the 21st century. When it comes to investing, the psychological divide between millennials and Gen Z is stark, revealing a fundamental difference in their relationship with risk, trust, and technology. Shaped by the trauma of 2008, many millennials approach investing with a fear of loss mindset. Their strategy is often rational and conservative, prioritizing long-term diversified investments that feel tangible and safe. They are drawn to assets like real estate, index funds, and ETFs vehicles that promise slow but steady growth and are backed by established institutions. Their trust lies in proven systems and expert advice. Gen Z, having been raised in a world where technology disrupts every industry, operates with a completely different framework. They are more comfortable with volatility and have a greater belief in the power of digital assets and decentralized finance. Having witnessed the meteoric rise of tech companies and cryptocurrencies, they are more willing to take calculated risks on high-growth, albeit speculative investments. They are digital natives who confidently use micro-investing apps, trade fractional shares, and explore the world of crypto. The rise of FinTok and Reddit communities like Wall Street Bets demonstrates a major shift. Financial advice is becoming entertainment-driven. shortening investment horizons and replacing traditional authority with community consensus. This represents a fundamental difference in trust. While millennials have a trust deficit born from institutional failure, Gen Z has a trust surplus, a deep-seated belief in the power of technology and peer-to-peer networks to create new pathways to wealth. In today's hyper-connected world, money is no longer just a functional tool for transactions. It has become a form of performance. Spending is now an act of self-expression, a way to broadcast one's identity and values to the world. This identity economy is a powerful force shaping consumer behavior, particularly for younger generations. Gen Z, more than any generation before, uses their purchasing power to signal who they are. They spend on fashion to express their individuality, support brands that align with their ethical values on sustainability and inclusivity, and curate an aesthetic that defines their personal brand. For them, a purchase is a statement. Millennials also participate in this identity economy, but their spending is often geared toward projecting a different kind of identity, one of social stability and success. Their significant purchases like property, brand-name gadgets, or family-oriented experiences are often meant to signal that they have made it and achieved the milestones expected of them. A key driver of this performative spending is the influencer economy. The parasocial relationships that users form with influencers, a one-sided feeling of intimacy and trust, can have a profound impact on financial decisions. When an influencer recommends a product or a lifestyle, it doesn't feel like a corporate advertisement. It feels like a genuine suggestion from a friend, making it incredibly persuasive and blurring the lines between personal identity and consumer behavior. The way each generation acquires financial knowledge is another critical point of divergence. The entire ecosystem of financial education has been radically transformed, shifting from centralized institutions to decentralized digital platforms. Millennials largely learned about money through more formal or traditional channels, perhaps a high school economics class, advice from their parents, or books written by established financial experts. This path was often slower, more methodical, and inherently more risk-averse, as the information was vetted by gatekeepers. Gen Z, by contrast, is learning about finance in the fast-paced, democratized, and often chaotic world of the Internet. Their financial education comes from YouTube tutorials, TikTok explainers, and Reddit threads. This peer-led model has democratized access to financial information on an unprecedented scale, empowering a new generation of investors. However, this democratization comes with a significant challenge: information overload. The sheer volume of content makes it difficult to distinguish credible advice from dangerous misinformation, which can lead to a false sense of overconfidence and risky decision-making. We are now seeing the emergence of a new trend that aims to bridge this gap: AI-powered financial mentors and budgeting apps. These tools adapt to personal data, combining the power of machine learning with an understanding of human psychology to offer personalized guidance, representing the next frontier in financial literacy. After exploring the deep-seated psychological, economic, and technological divides between these two generations, it's easy to see their financial journeys as a competition. But the future is not about division. It's about collaboration. The different strengths and perspectives of millennials and Gen Z, when combined, create a powerful force for building a more resilient and innovative financial future. The narrative is shifting from one of conflict to one of synergy. Millennials, with their experience, institutional knowledge, and drive for stability, are becoming the business builders, the innovators, and the leaders pushing for sustainable corporate practices from within. Their cautious but determined approach provides a necessary foundation for long-term growth. Gen Z, with their digital fluency, social consciousness, and willingness to challenge the status quo, are the early adopters, the social investors, and the ethical consumers driving demand for a more transparent and equitable financial system. Together, their roles are complementary. Imagine a future where millennial-led companies are funded by Gen Z's social impact investors, or where Gen Z's digital marketing savvy helps scale a millennial's sustainable business. The future of money isn't about age. It's about adaptability, emotional intelligence, and collaboration. By understanding and valuing each other's unique perspectives, these two generations can collectively navigate the complexities of modern finance and build a more prosperous future for everyone.